Okay, hi all. Let's continue with our discussion on gold. And if you recall, in the last session we discussed a little bit about who are the major consumers of the gold. I discussed about the central banks and investors, retail investors, individuals who have interest in buying gold jewelry as well as buying gold coins and gold bars. You have industry, and in India specifically, a lot of these temples and trust are owners of the gold. So a lot of people donate gold, and in this context I also mentioned about the Lord Vishnu's gold idol, which was weighing around 32 kg, and I showed you the picture of that. And we also discussed I also briefly mentioned about how gold ETF are one of the gold ETFs have contributed to the demand for the gold. So briefly let's discuss what is a ETF, and if you don't have much of a knowledge about the ETF, I will advise you to go to a National Stock Exchange website or any other website where they have information pertaining to ETFs. But this much I can tell today, that ETFs are nothing but mutual funds. In regular mutual funds, you have underlying investment, can be equity or bonds or combination of equity as well as bond. In case of a gold ETFs, the underlying asset is gold. So as I mentioned, gold ETFs are mutual funds, and these units of these mutual funds are backed up by physical gold. And every unit, ETF unit, gives the owner some specific amount of the gold. And ETFs can be ETFs are normally listed in stock exchanges, and these ETFs are traded in stock exchanges based on the net asset value, and it has got a strong relationship with the gold price. So whenever the gold price increases, the asset under management, that is the amount of gold held by these ETFs, increases. So there is a direct correlation between ETF investment in gold and gold price. This particular picture shows this relationship. If you see, this is the red line shows the gold price, and this blue line shows the investment in all ETFs in terms of troy ounce, million troy ounce. So if you see, there is a positive relationship between these two figures, and though it is not available at this point of time, simple Excel calculation shows the correlation to be 0.94. and this information I have downloaded from the Bloomberg database. So what is this ETF GT total index? So this consists of all asset under management for all ETFs which are listed and traded in major exchanges all over the world. Now let's go to discuss little bit on how does the spot price is arrived at. See, if we go to a local jeweler, we get to see some price. In fact, if you go today, you get to see something 27,450. Next day you go, you may end up seeing around 27,920, so on and so forth. So where does this what factors influence, or who quotes this price? So one thing here I would like to mention here, even if we see a price variation in these shops, India has nothing to do with price setting. India is a price taker. So gold price gets decided at LBMA, that is your London Bullion Markets Association. So LBMA sets the price of the gold in US dollar, euro and pound sterling, and this dollar price and all these prices gets relayed to all over the world, and this price multiplied by the exchange rate becomes the price of the gold prevailing for that given day, and this price gets set by LBMA twice a day. So the probably if you go to a big jeweler, the price which is prevailing in the morning would be different than the price which is prevailing in the afternoon, though mostly in Indian jewelers so only one price, but in international jewelry houses you can have two prices displayed on a given day. Now this London Bullion Market Association, it not only fixes the price for the gold, it also fixes the price for silver, palladium and platinum. However, today gold being our focus, we will be discussing more about the price fixation aspect of the gold, and the same process is undertaken for price fixation of silver and palladium and platinum. Now if you know the importance of importance of London in gold market, it is just lot of historical events are behind it, and London gained importance for major trading of the gold and London Bullion Market Association is setting the price for gold from I think around some 1600 something. Please visit this LBMA website for history, so that you get to know about the history of price fixation by LBMA. And when we talk about the word ounce, it is equivalent to 31.1035 gram. So when we are hearing that gold is around $1200 per ounce, so that is equal to $1200 is equivalent to 31.1035 gram, and in India mostly prices are quoted as per the 10 grams. So what we get to see mostly on the shops or newspaper publication is with respect to 10 gram or a tola. And as I mentioned, spot gold price gets fixed twice daily, that is morning fix and afternoon fix. And let's first understand how exactly the fix is arrived at. So it is nothing but LBMA collecting quotations from buyers and sellers and matching it, and try to identify a price in which the maximum amount of buying and selling can be done. So this LBMA has a 5-member committee. Who are these 5 members? It is listed here: Bank of Nova Scotia, HSBC, Deutsche Bank of London, Societe Generale and Barclays Capital. So these 5 members. So how exactly this spot price fixing is done? So this spot price fixing is done, morning fix is done at 10:30 a.m. So at 10:30 a.m. London time, the chairman of the gold fixing committee, so whoever is the chairman, he starts with calling, starts with by giving a price. Let's say he quotes around $1300. So with this $1300, or this $1300 will be known as a trying price. This starting price is known as the trying price. So at this $1300, all these 5 members will start getting in touch with their own clients, who are big banks and big jewelry producing gold mining companies, banks and gold mining companies, who are the members of these 5 banks. These banks will be collating their buy and sell order at this $1300 per ounce price, and this amount of buy and sell will be relayed to the chairman. And if the buy and sell order is within 20,000 ounces, then that price will be fixed for the day. Then let's take this example. Let's say the chairman of gold fixing committee quotes a price of $1,278 per US dollar, and this price gets relayed to the clients by the members. So, this 5-member team, they relay this price to, or they inform this price to their clients. So, the clients start giving buy and sell orders. So, each of these 5 banks start collating the buy and sell order, and let us say as given in this particular table, at this $1,278 US dollar price, Bank of Nova Scotia clients gave 80,091 ounces for buy, and what is the sell volume? 81,075 ounces. So, if you see similarly HSBC, their clients gave different buy sell. So, Deutsche Bank, Societe Generale and Barclays Capital. Now, let us say what is the net volume, or how much Bank of Nova Scotia is going to inform to the chairman of the fixing committee. Bank of Nova Scotia will, the net volume, that is 984 sell volume will be informed by the Nova Scotia. HSBC will accordingly inform 3,268 ounces as sell volume, but Deutsche Bank will inform 8,925 as buy volume. 15,302 ounces will be informed as a buy volume of Societe Generale, and 2,964 will be the buy volume of Barclays Capital. Now, sum total of the sell volume, which is 984 plus 3,268, it is coming to around 4,200 something. So, that is the total of the sell volume. And what is the total of the buy volume? Total of buy volume is around, if you sum to all these 3 buy volumes we add up, it is coming to around 27,000, sometime around 27,000, something around 27,000. Now, the difference between sell and buy is more than 20,000 ounces. In that case, this 1,278 will not be the fixed price. The sell volume is less than the buy volume. So, what the chairman will do? Chairman will reduce the price or increase the price. There are more amount to be, there are more amount to be bought as compared to the more amount to be sold. So, the chairman will be increasing the price and again announce a higher price, and this price again will be relayed by these members to their clients, and different set of buy and sell volume will be collected and collated, and this process will go on till the buy and sell volume difference is within 20,000 ounce. So, once this this limit is reached, the chairman will be stopping the process of finding out the price, and that becomes, whatever price is arrived at, that becomes the price for the morning fix. The same process will be repeated in the afternoon, and the same process is also done for silver, palladium and platinum. Let us go to this particular table. If you see London gold price fix, which is at AM fix and PM fix for last 5 days, and if you see morning fix for different days is morning and afternoon fix is given. And one interesting observation I want all of you to note here, on 23rd June the morning and afternoon fix is around 1,260 ounces, 60 US dollar per ounce. However, on 24th June, if you see, within a 1 day there is around 35 plus 813, so $48 of price change, that is delta of $48. And you know what is the reason? The Brexit announcement was made on 24th June, and so if you recall, gold is a safe haven asset, or whenever economy is in a not performing well, or there is uncertainty with respect to the performance of economy or whatever is happening in the economy, most people flock to the gold, and it is very clearly obviously visible from the price difference within a given day. This data again I have taken from LBMA website. And if you see, investors are flocking to gold and other safe haven asset after the Brexit vote, and not only the gold price has gone up, the shares of gold mining companies have also gone up significantly. So this information is this link provides this particular document. You can read in detail if you are interested. And also every year LBMA conducts a survey to know what is going to be the views of, or what is the direction of gold price, gold, silver, platinum, palladium price for the year to come. So the survey is normally conducted in the month of January, and the survey reports are made available, where important big players in the gold and all silver, palladium, platinum industry are asked regarding their views. And the interesting fact is that none of them said in the month of January that gold price is going to be going up to $1,300. So I'll just take a couple of minutes to show you more about this particular PDF, this particular document. Please see this one. So if you see, this is your AU is your, these are the, if you can, I hope you are able to see this. You have your for gold, Adam Williams of First Market Limited, he has predicted gold price is going, maximum gold price is going to be 1,222 with a minimum of 980 and average of 1,132. So different people have different from different banks and investment companies, they have been asked to give their views with respect to the gold. And if you see, the average is lowest is 978, average is 1103, and maximum is 1231. So none of the none of the people could identify or could foresee what is going to happen post Brexit, and gold price increased to hovering around 1,365. Sorry, from 1265 it has gone up to 1313. Similarly, other for a silver is also there is similar kind of a prediction, and platinum and palladium. And please note that I am not going to make this particular information available to you all. The link is available. If you are interested, you can download this particular document, because this document is not supposed to be freely circulated by the people who are downloading it. Now let's go to our understanding on the relationship between gold spot and forward and futures price. So the same cash and carry arbitrage is applicable to the gold forward and futures price relationship. Let's take an example how how gold futures price work. So let's go to this slide, which is the information given in the PPT. Let's say a gold producer would like to sell gold at a later date. What is the gold mining company's fear? The fear is that price is going to go down. Maybe at this point of time, some of you may be thinking this is not a right fear, but let's say if we go back to the 1990s, this was a very real fear that gold price remained at around $300 per ounce, and it progressively went down. At times it had gone up gone down to even $254-$55 during 1994-95. Now let's say the gold producer has a fear of gold price going down, so it wants to enter into a forward contract and the price at which it should bid. So what should be the forward contract price or a futures contract price? So let's take an example here. So what the gold producer or gold mining company can do, it can borrow gold at spot date. So today's price it can borrow gold and agree to pay interest for borrowing gold. So whatever the gold borrowing rate, it will agree to pay. It is denominated in rupee or dollar terms, but it is much lesser than the interest rate. So if you go and if you want to go and take a loan from a bank, the rate at which you will borrow probably will be much lesser than if a particular company goes and borrows gold from a body which is willing to lend gold. Let's say a central bank which is holding gold, that central bank can lend gold to somebody, and the rate which the central bank will be charging will be a gold lease rate. So this producer borrows gold at on a spot date, pays the leasing rate, simultaneously sells the gold in the spot market and makes a fixed deposit from the sale proceed. So what is going to be the future price at a later point of time? Let's take the numerical example mentioned here. So gold spot rate is, let's say, 1313 per ounce. Gold lease rate is, let's say, 0.75% per annum, and prevailing interest rate, that is your LIBOR US dollar rate, which is 1.20% per annum. If some of you are not aware of what is LIBOR rate, that's LIBOR stands for London Interbank Offer Rate. So please go to the appropriate website and find out how LIBOR is calculated. So basically LIBOR is a interest rate. LIBOR is calculated in many currencies. So we are taking the LIBOR 12-month interest rate denominated in US dollar. So that is your 1.20% per annum. Maturity is 6 months. So if you take this one, the theoretical futures price, theoretical future or forward price is equivalent to 1318. So 6 months from now, the company should be willing to or today companies should be willing to enter into a futures or forward contract at a price of $1318 per ounce. So as long as you have the prevailing interest rate more than gold lease rate, so as and when as long as the interest rate, prevailing interest rate is more than the gold lease rate, the theoretical forward or future price is going to be more than the spot price, and the market is going to be in contango, that is spot price is going to be less than the future price. So in case of a gold, the market is supposed to be contango. So spot price is going to be less than future price, and far month future price should be higher than the near month futures price. Or let me put it other way around, that is near month future price is going to be more than the spot price, and far month future price is going to be more than the near month futures price. Now let's I have downloaded some data from Bloomberg, so quickly I'll just show you or briefly we'll discuss this aspect. So what are the information which I have downloaded? If you see this aspect, I have already shown it to you. It is the movement of gold price per ounce, spot gold price per ounce, and if you see around July 99, June July 99, it was hovering around $250. So let me make it a little bigger so that you are able to see. June July it was hovering around 256, around May it was around 356. And it remained within below 300 label for substantial number of years. So it is around 2002 it remained less than $300, and progressively it increased, and it reached 1778.95 per ounce in the year September 2011, and it has from from a peak of this value, it has come down to around 1260 for dollar during May 2016. So I just also did some contango backwardation calculation, and I said that gold should not exhibit gold should always have a contango structure, but the actual data shows there is contango as well as backwardation, and there was a lot of debate and discussion going in the media the reasons for the backwardation, and the reasons cited are the negative interest rate, uncertainty regarding the future economy and future global economy, and huge demand from Chinese people to hold gold in the current form. So so basically strong demand for the spot market in the spot market had resulted in spot prices increasing at a higher rate as compared to the futures price. Now let's go to the gold forward curve. So what is this gold forward curve? Gold forward curve is the price movement of different maturity curve. So this is, I have just randomly chosen 4 days. So let me increase this size. Let's focus on this particular picture. So this gold forward curve randomly I have taken. So for the last date which I have considered is 24th June. On 24th June, this this shows a contango. Almost all these days it shows a contango structure. In fact, the backwardation on gold backwardation or gold futures price being less than the spot price has happened only at the near month contract. That is, the near month contracts are lesser than the spot prices, but as we have moved into the far month contracts, they are more than the spot price. So this particular picture does not have the spot price incorporated into it, and this shows for let's consider this particular 24th June price. So M1 price shows the contract maturing in July, August, so on and so forth. It has gone up to M21. And this picture I have already shown it to you, the relationship between ounces of investment by ETFs with respect to the gold price, and this is what I was mentioning, the correlation of 0.94. So let me make it bigger. So this gold ETF and gold ETF investment and the gold price, which has got a positive correlation of 0.94. And when it comes to gold ETF in India, we have substantial number of gold ETFs available listed at National Stock Exchange. So which are the ETFs? So you have Axis Mutual Fund, Axis Gold, HDFC Mutual Fund, so on and so forth. So if you are interested to see what are the structure of these ETFs and all more information pertaining to this gold ETFs, you can go to National Stock Exchange website and spend some time. So this aspect we have already discussed. Now let's quickly go to the derivative contracts on gold, and in India, in Indian exchanges, many predominantly gold futures contracts trade in terms of various lot size. So you have MCX gold has gold futures has 1 kg gold. It has got gold mini, which has got 10 gram as underlying, gold guinea has 8 gram as underlying, gold petal has 1 gram as underlying. And maximum maturity is for 12 months. This is one of the largest longest duration contracts available. Most of the agri commodity and energy commodity can have 6 to 8 max 6 to 8 months into the future you can take futures position, but for gold you have maturity running it to 12 months. And the final settlement price or due or date rate price is calculated based on the pool price at Ahmedabad or futures price at international some international exchanges multiplied by the RBI reference rate. And good delivery list, this is something which is I thought of discussing a little bit. Remember, in case of crude oil or in case of let us say soybean or any other agri commodity, the sellers will be taking the commodity, putting it in an exchange approved warehouse. The warehouse will have some quality certifier and assayer who will test the quality of the underlying and will certify whether the underlying goods are as per the contract specification of the exchange. But in case of a gold, this does not happen. No exchange takes the ownership of certifying the quality of the gold to be delivered. What they do, they identify some of the refiners whose gold they will be accepting as the delivery. So the responsibility of delivering quality gold lies with the refiner. And the exchanges do not have the infrastructure or capacity to test the quality of the gold, because quality testing can be quite expensive. It requires different kind of infrastructure and all. So no exchange all over the world take that responsibility. Now let's go to the good delivery list. So as per the NCDEX, which are the good delivery list refiners. So these are, if you can see, it runs into how many, it runs into 2.5 pages. So substantial number of refiner name and is given. So let's take like Boliden Commercial AB. So this is the Sweden, and the location of the refinery, I am sorry, I am having difficulty pronouncing this, Skelleftehamn. Okay, so this particular refinery, so refinery of this Boliden Commercial AB can be gold bar coins produced at this refinery can be delivered at the NCDEX platform. Interestingly, only one refinery in India certifies that is your MMTC PMP India Private Limited. This this refinery is at Mewat. So with this, we will come to an end on discussion on the second session on gold, and we will be resuming with the remaining part of the gold in our third and final session. So thanking all of you, and we will be continuing with our discussion from the good delivery list aspect. So looking forward to meeting you all in the next session.